Welcome, everybody. Hard to believe there's 2 months in the books already this year, but that's exactly where we find ourselves. We did have some questions that were emailed in after last week's webinar, so I'll be addressing those as we go through the material today. And no shortage of things to talk about, so let me jump right in as I've got a little bit more material than I normally would for a headline roundup webinar. I want to talk about how the economic sanctions imposed on Russia are moving India now away from the US dollar. So pretty unobserved dynamic that I read an article on this past week. Gas prices are moving up and they're set to move even higher. I'll talk a little bit about where you might see those go. Jim Records, a past guest on the RLA radio program, is talking about the U.S. dollar this past week and how he sees the dollar's role in the world changing. I'm going to share with you a bit about what he said. And the narrative from many politicians are that inflation is actually due to greedy corporations. I'm going to address that. And it seems now, in light of geopolitical tensions, that the Fed will slow the taper. I predicted they would do that anyway, so I'll talk a bit about that as well. So a lot to talk about as we go through the material today. If you have a question or comment, go ahead and type it into the type your comment box on the right-hand side of the screen. So this actually was an article I found this past week. It starts out by saying, well, China is still trying to not fully alienate the U.S. while effectively siding with Putin in Ukraine. Asia's other superpower, India, has no such qualms. And according to Nikkei Asia, India is exploring ways to set up a rupee payment mechanism for trade with Russia to soften the blow on New Delhi of Western sanctions imposed on Russia, including a potential expulsion from SWIFT. Now, SWIFT is a U.S. dollar-based clearing system used in international trade, and the threat is to kick Russia out of SWIFT so they can't settle trade in U.S. dollars. Putting its own national interest first, Indian officials are concerned that vital supplies of fertilizer from Russia could be disrupted as sanctions intensify, threatening India's farming industry. Russia and Belarus account for a third of India's potash imports. It would not be feasible to replace them amid a rally in fertilizer prices to a record high. So India is trying to figure out how to avoid a problem with their farming industry. So the plan is to get Russian banks and companies to open accounts with a few state-run banks in India for trade settlement. In other words, that would allow them to bypass the U.S. dollar completely. Now, the Nikkei source says this is a proactive move, assuming that the conflict escalates and there could be a slew of sanctions in place. In this case, we would not be able to settle the transactions in dollars, so an arrangement has been proposed to set up a rupee account, which is the Indian currency, which is being considered. Funds in such accounts act as a guarantee of payment for trade. Essentially, it's collateral, and then the parties barter commodities from each other to offset the sum. China has gold-backed trade notes with many countries as well that also bypass the U.S. dollar. So ironically, these sanctions being imposed on Russia by the U.S. Will potentially move India and other countries that trade with Russia away from the U.S. dollar. And that's a movement that has already started. And I'll talk more about that as we go through the material today. First, though, Charles Kennedy reported this past week that the average price per gallon of gasoline, $3.57 as of last Friday. The gas price increase to $4 will likely happen in the next few weeks. And fighting the surge in gasoline prices will be tougher today than it was last year when crude was released from the Strategic Petroleum Reserve. So AAA is predicting we'll see $4 gas very soon. A year ago, the average price for a gallon of gasoline was $2.65. Russia is one of the leading oil producers globally behind the United States and Saudi Arabia. U.S. oil production has incidentally declined, so this will likely lead to higher fuel prices. President Joe Biden this week tried to quench worries about the security of energy supply, saying we're closely monitoring energy supply for any disruption, and we're executing a plan toward a collective investment to secure stability in global energy supplies. I'm not exactly sure what that means. Fighting the surge in gasoline prices will be tougher than when crude was released from the strategic reserve last year. There's a tight global supply of crude already. That's been causing prices to go up. And second, there's the fact that the U.S. is a major importer of crude oil and has a limited source of it because of its sanctions against Venezuela. As a result, Russia has become a major supplier of the heavy crude U.S. refineries need to produce fuels. Sanction action on Russia's energy industry could interfere with Biden's plans for reining in fuel prices at home. So two big oil producing companies, both of which the U.S. is imposing sanctions against. Now, this is all leading to a move away from the dollar, not to mention the sanctions are one thing leading to a move against the dollar, but obviously all the currency creation is also leading many countries to look at alternatives. Now, Jim Rickards comments on this, in my view, very objectively last week. And the headline of his article says, "The dollar is a victim of its own success." He starts the article by saying that the most powerful weapon of war that the U.S. has is the dollar. It's not a submarine, plane, tank, or laser. It's not a military weapon. It's the U.S. dollar. Rickard says the U.S. uses the dollar strategically. They reward friends and they punish enemies. The use of the dollar as a weapon is not limited to trade wars and currency wars, although the dollar is used tactically for those reasons. Rickard says the dollar is much more powerful than that. The dollar can be used for regime change by creating hyperinflation, bank runs, and domestic dissent in countries targeted by the U.S. Incidentally, if you think that sounds a bit hypey, you should read the book Confessions of an Economic Hitman. It is a fascinating read. I would encourage you to check it out. The U.S. can depose the governments of its adversaries or at least blunt their policies without firing a shot. Now, Rickard says the dollar currently constitutes about 60% of global reserves, down from a much higher number, 80% of global payments, and almost 100% of global oil transactions. European banks that make dollar-denominated loans to customers have to borrow loans to fund those liabilities. So if you're in Switzerland or Germany, you still have to deal at this point in dollars. Now this, Rickards gets into the payment system. So the U.S. controls the dollar, but also the dollar payments system. And this relates, as you'll see there, to some systems and the SWIFT system as well. Now, Rickards goes on to explain that a dollar payment going from a bank in Shanghai to another bank in Sydney runs through one of these U.S.-controlled payment systems. It doesn't go direct from Shanghai to Sydney. In short, the dollar is the oxygen supply for world commerce, and the U.S. can cut off your oxygen whenever it wants. Now, Rickards goes on to say the list of ways in which the dollar can be weaponized is extensive. So some examples are the U.S. slapped sanctions on Russia after the 2014 annexation of Crimea and invasion of eastern Ukraine. The U.S. waged a full-scale financial war with Iran from 2011 to 2013 that resulted in bank runs, hyperinflation, local currency devaluation, and social unrest. The U.S. slapped stiff penalties on China for theft of intellectual property. Other obvious victims of U.S. financial weapons are North Korea, Syria, Cuba, and Venezuela. The actions above, the ones just described by Rickards, didn't arise in the normal course of trade and finance. The Russian, Iranian, and other sanctions noted are explicitly geopolitical, just like the ones we're seeing presently, while the Chinese sanctions are geostrategic to the extent the U.S. and China are vying for technological supremacy in the 21st century. None of these sanctions would be effective or even possible unless the dollar and the dollar payment system was widely used. Now, this goes into what I led today's webinar with, that ironically, sanctions against Russia are leading India to look for dollar alternatives. Rickards puts it this way. He says, for every action, there's a reaction. America's adversaries realize how vulnerable they are to dollar-based sanctions. In the short run, they just got to deal with it. But Rickards says they're not standing still. They're already looking ahead and envisioning a world where the dollar is not the major reserve and trade currency. Russia, China, Iran, and others are working flat out to invent and implement non-dollar transactional currencies and independent payment systems. Rickards says, I've been warning for years about the efforts of nations like Russia and China to escape what they call dollar hegemony and create a new financial system that does not depend on the dollar. These efforts are increasing. So as the Federal Reserve continues to create dollars out of thin air, as sanctions now are causing countries to look away from the US dollar, these countries are now looking for alternatives. Now, Rickards goes back and talks about gold and references gold correctly as the oldest form of money. The use of gold, Rickards says, is the ideal way to avoid U.S. financial warfare. Gold is physical, so it can't be hacked. It's completely fungible, so it cannot be traced. Gold can be transported in sealed containers on airplanes, so movements cannot be identified through wire transfer message traffic or satellite surveillance. Russia can settle its balance of payments obligations with gold shipments or gold sales and avoid U.S. asset freezes by not holding assets the U.S. can reach. Now, to put that statement in context, about a month ago here on the Headline Roundup webinar, I reported to you that the Russian central bank now has gold as its primary reserve asset, eclipsing the US dollar for the first time in history. So Russia actually has more gold than they do US dollars, which puts them in a pretty good position to start to do what Rickards is describing. Russia is providing other nations a model to achieve similar distance from U.S. efforts to use the dollar to enforce its foreign policy priorities. Now, Europe is showing signs it wants to escape this dollar dominance. The German foreign ministers called for a new European Union-based payment system independent of the U.S. and SWIFT. They're looking for a system that does not involve dollar payments. Now, Rickards explains what the SWIFT system is, but essentially it's a dollar-based payment system that all major banks use. Now, the U.S. banned Iran from the dollar payment system at one point, but Iran returned to SWIFT to transfer euros and yen in order to maintain its receipt of hard currency for oil exports. The U.S. successfully kicked Iran out of SWIFT in 2013. This meant Iran couldn't receive payments for its oil in hard currencies, and that's what led to a nuclear deal with the U.S. in 2015. But Rickard says the big picture is this: in the long run, this is just pushing the world at large away from dollars and toward alternatives. He said, imagine a three-way trade in which North Korea sells weapons to Iran, Iran sells oil to China, and China sells food to North Korea. All of these transactions can be recorded on a blockchain and netted out on a quarterly basis, with the net settlement payment made in gold shipped to the party with the net balance due. He said that is what's coming. The bottom line is this: the world is looking to turn away from dollar dominance in global finance, and it might end a lot sooner than most expect. We're getting dangerously close to that point now. And James has a very good point. He said if a lot of countries stop using the U.S. dollar and those dollars start coming back to the U.S., that would cause a hyperinflation situation. And James, I agree with you completely. If, for example, you look at all the dollars that are being inventoried around the world, one of the reasons that the Federal Reserve has gotten away with so much currency creation is that a lot of these dollars are exported. Excuse me, it's a pretty good deal. You can print new currency and trade it for steel, trade it for agricultural imports, trade it for new Toyotas, because the dollar is the dominant world currency. But if that changes, as James correctly points out, we will definitely see much higher inflation. Now, I want to stop just for a minute because there was a question posed after last week's Headline Roundup webinar by John. And John wrote this in email. He said that you've warned us to beware of a bank bail-in during the next crisis. Now, to explain bail-in, if you go back to 1933, when Franklin Roosevelt actually made it illegal to own gold in the United States, shortly at that time, approximately, there was a bank holiday that was actually declared. And that was really solved with a bail-in. If you had money in the bank, you lost it. Now, contrast that to 2007, 2008, when then Treasury Secretary Henry Paulson got on television and explained to the country that he needed $700 billion that day from Congress, or the financial system as we know it would fail. That was a bank bailout. Bail-ins are by far more common when you take a look at what's happened historically when there are banking issues. And I would point out that there are, worldwide, there's about $300 trillion in debt, far more debt than can ever be paid. And a lot of that debt is held by banks as assets, which means that I believe there's a high probability we're heading for another banking issue. Now, John, in his email, continued by saying that hard assets would be a smart alternative, but he asks, what about holding stock in a brokerage account in precious metal mining and royalty companies? Is there a danger these might get seized in a financial crisis, and would holding the stock certificate solve this potential problem? So there's three questions there. First of all, I don't know what would get seized in a financial crisis, but my sense is shares that you own in stock would not. I think that owning shares in precious metal mining and royalty companies can be a good inflation hedge, but keep in mind, shares do carry some counterparty risk. In other words, those shares are only worth something if those companies remain in business. So certainly, I think you want to have some hard assets. I think that should be your primary insurance policy, if you will. But certainly owning shares in precious metal companies can be a good inflation hedge as well, but they are not without counterparty risk. And I see we have a few more people joining us. So if you do have a question that you'd like to have me try to address, you can type it in the Type Your Comment box on the right-hand side of the screen. If you have a question that comes up during the week, you can email it to information@yourrla.com. That's information@yourrla.com. And I will certainly get that, and we'll address it on one of these Headline Roundup webinars. Michael Mahari writes for Shift Gold, and he points out that the increasingly popular talking point is that greedy corporations are causing inflation and they're enjoying record profits. He points out correctly that that statement is patently absurd. He said you have to reason through the claim to uncover the absurdity. And he asks a really good question. If corporations can willy-nilly raise prices and enjoy excessive profits, why don't they do it all the time? Did corporations just suddenly get greedy in 2021? And why did the Federal Reserve spend a decade fretting about inflation being too low as it struggled to hit its 2% inflation target? Wasn't there enough corporate greed before coronavirus? He said, it's pretty clear there has to be something else going on. And Jerry, I see your question. I will get to that momentarily. Thanks for your question. Corporate greed is a convenient explanation. And the narrative continues to grow because the average American does not understand inflation or basic corporate accounting. He said, and that includes a lot of people writing about inflation in the media. Jack Nichols is one of those people. He exposed what he called a dirty secret. He said the current bout of inflation is caused by corporations, quote, jacking up prices, end quote. Michael says that's how you say I don't understand inflation in just one tweet. Nichols' author page calls him a pioneering political blogger, and he might be a great writer. He might know a lot about politics, but he doesn't know a lot about finance, and I would certainly agree. If you look at some of these terms that are used in the corporate finance world, one of those terms is revenue, which is simply the amount of money generated by normal business operations. Operating income is that gross revenue amount minus operating expenses like wages, cost of goods sold. Basically, operating income is the profit from business operations, but it does not include taxes, interest expense, and debt service. That would be net income. Net income is a number often reported as profit. Now, growth is not a technical accounting term. However, growth is often reported this way. Mahari says, XYZ company's profits grew by 35% last year. He said, you want to be aware of this kind of reporting because it can be highly deceiving. For example, if a company had a really bad year, say because the government shut the economy down, and then it rebounds the following year, it's going to show tremendous growth. But that's only because of what you are comparing it to. Now, Nichols, the aforementioned blogger, said, oil giant BP, British Petroleum, reports highest profit in 8 years on soaring commodity prices. Now, that headline really doesn't tell us anything. He said when you dig in, BP had revenue of just under $300 billion in 2018. That dropped to $180 billion in 2020 and $157 billion in 2021, about half of where it was in 2018. BP's operating income was $16.3 billion in 2018. In 2020, it had a loss, and it rebounded to $10.5 billion last year. So certainly that is good when you compare it to the prior year, but that comparison is really without context. Now, there are a number of other examples here. Kellogg, for example, forecast full-year profit growth above market expectations on Thursday, riding on higher product prices. And when you take a look at the explanation, you see that Kellogg also had higher operating costs. So growth is not profit. There's similar reporting going on. McDonald's to raise prices despite record revenue. Well, revenue is not profit. If record expenses are higher than record revenues, then that's not good news. You want to look at net income. Amazon stock soars 15% after earnings, will hike Prime membership fee. Well, Amazon's operating income was down 50% year on year in the fourth quarter. The company did really well in 2020 because everybody was locked up in their houses spending stimulus money. But shipping costs are now rising and Amazon is feeling the pinch. See, the bottom line is that none of these headlines really proves greedy corporations are driving inflation, because they're not. Inflation is caused by increasing the money supply. That is the definition of inflation. Now, I've got a question here from Jerry, who said, would now be a good time to purchase land? Jerry, I think the answer to that, in my opinion, is it depends. I think that residential real estate may be in a bubble here. I think commercial real estate may also be in a bubble here. If I was going to buy land here, I would be focusing on select farmland. Farmland tends to track the price of agricultural commodities, and those at this point are headed upward. So that said, I want to get to my last topic in the time that I have left here. The Fed, as I've talked about, will, in my opinion, not be able to raise interest rates to the extent that they really need to get inflation under control. They won't be able to stop currency creation unless the federal government operates with a balanced budget. And the reality is, if they can't do it, if the math says they can't do it, then the reason they put forth publicly as to why they're not going to do it really doesn't matter. But we can pretty much rest assured that they're not going to blame their own policy for the problem that they find themselves with. So this is an article by Lance Roberts. He said that geopolitical risk now could be the reason the Fed gives to slow roll tightening monetary policy in March. He said, with Russia invading Ukraine, this would not be the first time that the Fed used geopolitical risk to remain cautious on changes to monetary policy. In fact, there's a Wall Street Journal quote here from 2016. The quote says this: weak global demand and geopolitical risks also argue for going slow, Mr. Powell said, as well as lower long-run neutral Fed funds rates and the apparently elevated sensitivity to financial conditions to monetary policy. So in 2018, the Fed was raising rates. They were moving assets off their balance sheet. The market reacted negatively. There were rising geopolitical risks with China, and the Fed decided to reverse course. Then they reversed course to an even greater extent when they bailed out everything in 2020 and started currency creation in earnest. Now, the signs are that the Fed's going to go down this road again. Mary Daly, who is a member of the Federal Open Market Committee, she is actually the president of the San Francisco Federal Reserve Bank. She said the Fed must navigate geopolitical uncertainty going forward. She was also very dovish, saying that rate increases had to be more gradual. So there's already this talk going on because of the Russian invasion of Ukraine. Now, I talk about this a little bit more in this week's Portfolio Watch. However, the Fed has a number of other issues also. Markets, I'm sure many of you have noticed, have not enjoyed a terrific 2022 through the first 2 months of this year. As a result, investors are now more bearish than they were in 2016, just before global banks went full QE to offset Brexit. If you take a look, this is the U.S. investors' sentiment bullish readings, and you can see now that investors are more bearish than at any time since 2016. You could view that as a headwind to tightening monetary policy. Consumer confidence is also lagging. It's really an important indicator in the U.S. economy because the U.S. economy is dependent 70% on consumer spending. Now, Ben Bernanke said this in 2010, easier financial conditions will promote economic growth. For example, lower mortgage rates will make housing more affordable and allow more homeowners to refinance. lower corporate bond rates will encourage investment. I'm not really sure that is true if you're buying corporate bonds, but if you're a corporation borrowing money for not much interest, then it does encourage investment. Unfortunately, that's not what's happened. What's happened is many of these companies have issued bonds and bought back their own stock. Bernanke continued saying higher stock prices will boost consumer wealth and help increase confidence, which can also spur spending. Well, Ellen Brown, who is a past guest on my radio program and a very bright lady when it comes to doing banking analysis, said this. She said the financialized economy, stocks, corporate bonds, and real estate is booming. At the same time, the bulk of the population struggles to meet daily expenses. The world's 500 richest people got $12 trillion richer, while 45% of Americans have no savings and nearly 70% could not come up with $1,000 in an emergency unless they borrowed the money. Brown said central bank policies intended to boost the real economy have had the effect only of boosting the financial economy. The policy's stated purpose is to increase spending by increasing lending by banks, which are supposed to be vehicles for liquidity to flow from the financial to the real economy. But this transmission mechanism isn't working because consumers are simply tapped out. This is not great news for a consumer spending dependent economy. And consumer confidence is showing this. This is a consumer confidence measure compared with the performance of the S&P 500. And this really makes Brown's point. If you take a look at the brown colored line, the tan colored line on the chart, it is the S&P 500. You can see that as the S&P 500 bottomed in March, April of 2020, you can see from that point, the market has gone up tremendously. It's gone from about 2,800 to about 4,500, more than 50%. At the same time, taking a look at the level of consumer confidence, it's gone from a level of just over 115 now down to a level of about 75. So the average consumer doesn't have confidence, but at the same time, the market has continued to climb. So those are the problems that the Fed faces, and I happen to believe, as I've indicated in the past, that the Fed's painted into a corner here, and they will likely definitely slow the taper. They probably won't be able to taper to the extent that they would like. The math tells us that that's the case, and it doesn't really matter what reason they give. The math is still the math. So that's what I have to cover. I'm a little bit over, but again, a lot going on. I'm going to hang out just for a second here to see if anybody has a question. If you do, just type it in the type your comment box. Well, Mark, I don't see any more questions. So again, we'll be back live next week. If you do have a question, you can email it to information@yourrla.com. That's information@yourrla.com. And I'll cover it on next week's webinar. Oh, we do have, Chris said Judy Shelton in today's Wall Street Journal indicated it's better if the Fed engaged in more traditional open market operations. Well, Judy Shelton is, in my view, a more rational voice. And certainly I think she is in the minority. But yeah, appreciate that comment, Chris. All right. I think, Mark, with that, we can go ahead and conclude. Thanks, everybody, for participating. Thanks for getting the word out. We'll talk again next Monday.